Hello, it's Makram Hani again on another BlockChat. I've not been with you for some time. However, Dennis and Peter last week or the week before did a great job, and I hope that we're keeping you updated with all the advances that we are doing as well as the industry. Today, we'll be talking about tokenizing real estate, in other words, single assets, be it an apartment, be it a building, or be it a complex, but it's a single real estate asset, or tokenizing a real estate fund, can be a real estate trust or a real estate fund. Now, there is several differences between tokenizing a property, a single asset, or tokenizing a fund. Some of those make the first better than the second. Some make the second better than the first. Today, we'll look at simple legal structures. We'll look at costs and how do those impact your investment in both cases. We look at different categories of funds. When does it make sense? When doesn't it? We look at different categories of real estate and how and whom does it make sense to. We will also look at who should buy what, which one of them, because that's what matters to us if we are investing. We're looking at an investment and we're looking at all the numbers. We're looking at how is it impacted by by the elements that surround it, the return, at the cost, thus the net return. How is that generated? The stickiness of the return, the sustainability and consistency of the return, and eventually we hopefully will end up with a proper investment that compounds the right way. Now, when we're investing, there are, in real estate in general, there are cash flows that happen periodically, depending on the country, the type of asset. There are also there is also capital appreciation, which takes place with time. Each of those is important to make the total investment the right investment. What passes through in what efficiency? You've all heard me say before, conventional methods of co-owning in general, so that no one hates me who is a fan of that. Conventional methods in general put the asset and your investment in a closed funnel, or let's say a funnel that's wide open at the entry, the beginning, and very narrow at the end. The entry is very easy. The end is very difficult. In other words, the exit is very difficult. And why is that? Real estate, as we all know, is a non-liquid asset, non-liquid investment. Yeah, it's not as liquid as owning an equity, owning a type of commodity in a non-physical manner, owning a type of bond or ETF, or so. Most instruments, generally investment instruments, are much more liquid than real estate in general. However, in general, when you take a property and put it in a conventional structure of fractionalizing, you make it even less liquid because of the structure and the nature of it. There are companies over the past 10 years that have done great advancements in that and have touched on methodologies that weren't used in the past, and in markets where it made sense and the timing helped them and it made sense to them, similar to the Dubai market. And few companies, I will not name one, but there is one that we all know that have done great at that. And you would see that it worked. Crowdfunding worked, and exits were consistent, beneficial, profitable. However, is there a way to make it better? Is there a way to make crowdfunding on steroids, where we open the tunnel from the end of it? So it's wide open on entry, it's wide open on entrance, on exit. And when you look at that route within the tunnel, the funnel, we look at the following. One, how efficient is that? How efficient was the whole transaction from entry to exit? Two, an exit we don't always mean exit of the property. Sometimes we mean exit of your position, which means you own a token and you want to sell it. Two, how much efficiency have been achieved within the route within the tunnel. So you've put $100 from here. How much comes out from the other side? And here, by $100 on the first side, it's not your $100 that went into it. It is the $100 that came from returns of the investment, and how much was eaten in fees and structures and management, and what came out from the end. So we'll discuss all that today. We'll have a fun, short block chat. Hopefully you'll enjoy it and you'll come out with something that's meaningful for you at the end. Write in the comments, please. Any questions you have, we'll answer them in the coming block chats, and we can answer some individuals in the comments as well. Let's start by tokenizing real estate. Now, there's obviously multiple methods in tokenizing real estate, and we'll not go in depth currently on all methods, but we will name them. Some of tokenization ends you up with a security token. Some tokenization, especially in jurisdictions like Dubai, in Dubai, actually, there's no jurisdiction currently like Dubai. You can tokenize the deed directly. You tokenize and impact the register. So you get a token that represents the title deed or a portion of it, which is amazing. That's the ultimate method of tokenization. Obviously, by ultimate, guys, we don't mean perfect without any gaps. Not really. I've written before, and multiple of us have written about gaps that occur and that happen. We're learning as we go. And as we test new things alongside you, we'll understand more, or we'll be awakened more by risks that we may have missed, ignored, or omitted, and we then get updated on it, and then we go back and we open the study box and we restudy what we're doing and what others are doing around us. We learn from what we do and from what others do. So that's the first type of tokenization, which is the ultimate method of tokenizing, because it doesn't use structures between the token and the property. So it's the token and the property with no funnel in between them that's long with costs and structures. In such an event, your token and your property do not have structuring costs, much of legal costs. Actually, it's as efficient on a purchase as purchasing a regular property in full, a full property. On exit, it is as efficient. On management, it's very close to being as efficient. Now, quality of manager and quality of asset matter, but here you're able to select your asset and you're able to look at the manager and the track record and select the manager as well. So that's one of the benefits of that. Now, in other jurisdictions, that's not possible. So you usually have SPVs, a holding, an LLC, or a sort of structure between the property and the token that doesn't kill the attempt, that reduces its efficiency. However, if you have a great asset that's performing highly, greatly, managed by a super manager in the right market, and you have that structure in between, or alternatively, you have an average structure, an average asset with no structure in between, I would always get to go to the better asset, regardless if there is structure. Some things come at the cost. Everything comes at the cost sometimes, and you pay for that, and it benefits you back. Now, when we talk about tokenizing a property, as we said, it can be a single asset, it can be a single building, and a single building can be a non-strata building where there is multiple tenants, multiple residents, or a single resident, but it's a single title deed. So it's one asset as a complete building or complex. It can be 20 townhouses in one title deed. Now, whenever you have a similar asset, you always have pros and cons. Let's talk about the pros first. An asset that is leased to one single tenant, you usually have a better quality tenant from a credit perspective. So the credit criteria of that tenant is better. The background of the tenant is better. Their ability to service their lease is better. And in general, you have a lower cost lease because generally in most markets, most categories of real estate. You find that in commercial. You don't find it always in residential. You have a triple net lease, triple A graded tenant, and plus, plus, plus. So all of those contribute to the quality of investment you're making, as well as it's less cost of management in general, because there's not much that can go wrong. There's no many moving parts. If it's a triple net lease, everything is being paid by the tenant. The job of the manager is generally an auditing job and an inspection job here and there to make sure that your asset is treated rightfully, especially if it's a long-term lease. Now, advantages and disadvantages of that. You have one tenant, great quality, but if that great quality tenant defaults, nothing is impossible until it happens. Or everything is impossible until it happens. But when that happens, God forbid, you lose the income on the property, and then you need to go back to the drawing board and re-lease the property and re-stabilize it. And it's a long process. And usually it's not as easy as leasing a single asset. Now, that same building can be leased to 70 tenants. Here, less quality of credit, less background, less credit. The credit profile is not as good. However, you have diversity of incomes within the asset. You don't have a long-term tenant, but you don't have the high risk of one tenant failing. Now, generally, the first is called institutional quality. The second is not, unless it's a certain way, which makes it close to that. But it's preferred to have a single tenant. I would say both have pros and cons. We mentioned some of the pros here. Some of the cons are that you generally have vacancies across the road. You don't have long-term leases where people stick to it. You can have a tenant leave after a month or 2 or 3. You can have a tenant default on a payment, and that is much more common when you have plenty of tenants than a single one. You, at the same time, in this situation, will have higher cost of management, because the cost of management here is no longer an audit job. It's no longer a tick of the box. It's a job of maintaining the property, making sure that the relationship with the tenant is right, making sure that if there is a vacancy, it's managed the right way, occupancy is managed the right way, inspections, checking the tenants' backgrounds, shortlisting tenants, relationship with the market, with the brokers. All of this are the jobs of the property manager. Sometimes there's also a portfolio manager in this case. So it's a more vigorous job. You have pros of no single tenant risk. You have cons of multiple tenant risks, as well as relationships that you need to manage. Now comes the benefits of having either, which is a single asset tokenization. In general, you're able to select the asset you want. You choose the asset. I like this area, and I like this market, and I like this building. And you can go as deep as I like this property manager in the future. Today, probably you don't have hundreds of tokenized assets in every vicinity, so there's not much choices on that for you. In the future, hopefully you will, and hopefully we'll have standardization and neutralization and normalization, as we talked about before. And when you do have that, you are able to choose the single exact asset, single exact tenant criteria, single exact cost criteria. That gives you a specific return on rental and a specific exit, hopefully benefit, specific or expected to be specific. And this is a great advantage for you as an investor. Now, we go to funds, tokenizing a fund. So rather than it being one transaction, it's plenty. Rather than it being one property, it's plenty. It can be 20 buildings, it can be 100 buildings, it can be 2,000 units. All of this has pros and cons as well. Whenever you've tokenized a whole fund, your ability to identify what's in the fund is less. Now, let's look at fund first, and let's look at what is valuable in a fund. Why is a fund, why does it work, and how does it work? First, you have diversity of assets. So rather than you having a single asset, be it an apartment or a building or a complex, you have plenty of assets. Two, generally, those assets have had more due diligence put into them. Generally, although on an asset, single asset, you have the ability to be opportunistic usually on entry if it is passed on to you. And we're not sure always that that will be passed on to you as a final token holder, but if part of it is passed on to you or a full of it is passed on to you, and we need to be realistic, the party initiating that will generally want to keep that as profit, and there is no shame in making profit at all. While in a fund, generally they go for assets that have a different criteria, less opportunistic, although some funds are opportunistic, less opportunistic, more sustainable and consistent. So generally, it's a higher quality asset that you have here, even if you didn't pay a more bargain price as you would have done in a single asset. Two, generally you have a all regulated funds, fund managers, more sophisticated individuals involved in that, be it on the portfolio management side or the property management side. All of this gives an advantage to the structure. Now, we said the structure. The structure can be of very significant cost, structure and everything under it. You have a much bigger operation, which weighs on the asset returns, on the net returns. At the same time, usually when you have a bag of assets, some of the assets may not be identifiable for you to the quality of what they are, and thus you have an asset that's performing greatly, you have an asset that's not performing, and they affect each other. Yes, it's diversification from within, but over there you're able to do diversification without having anyone decide it for you or the market decide for you. An asset is expected to stop returning, you exit it, sure if you exit successfully, profitably or not, but you exit it, and then you reposition to another asset. Here, you need the fund to exit and the fund to reposition. Sometimes the agenda may not be fully aligned, but let's say it is today. Let's say the agenda of the fund manager is aligned perfectly with yours. It's not AUM, it's not trying to get fees on assets under management and the funds under management, but let's say it is aligned with your interest because of the right structure. Still, we have a structure. That structure's weight on your investment will be reduced with size. If you have a $10 billion asset or fund, the cost of, let's say, 20 million will have less impact than it being a fund of 100 million and costs of 4 million, obviously. The kind of impact that has spreads and creates big impact on your net return. Now, costs are of very significant impact. If you look at anyone who knows investments, they will tell you costs, compounding costs are a huge impact and deterrent sometimes. Imagine 0.5%, which may not mean much to you, it's 50 basis points, multiplied by all what comes out of it and the returns of it over years, and let's take a 40-year time, and let's take a portfolio which is significant. The impact of that is huge. Do the numbers, take it on a $10,000 investment if your total investment net worth is $10,000, and put it on a 10 million if your total net worth is 10 million. And you'll see the same huge impact to your size today, to what you're doing today, to the returns today. So taking that into consideration, unless those efficiencies are improved with size, the impact is huge. With huge size, it's reduced. It stays there, but it's reduced. Now, as we said, we cannot select the assets here. The fund manager selects the assets. Usually there's step entry, different times, and they enter the market. Sometimes in the market would be great. Sometimes the market would not be great. You cannot time your entry to every single asset or exit from every single asset. What you can time is your entry into a fund and exit from a fund. You have more sophisticated managers, portfolio managers, asset managers, property managers, but you have higher costs to those. You have generally better quality tenants. If it's single tenants, they do full due diligence, background checks, shortlisting at a different level because they're more sophisticated. But here you have handicap from within. They measure the performance from within. Now, which is better? We will talk more about both, but let's talk generally, which is better. The first is something that you can create a fund of. You can choose 50 properties and take tokens off, and that's one of the benefits of tokenizations. Tokenization is that you're able to, with $100,000, spread over 50 properties rather than put your $100,000 over quarter of a property or half a property or a small percentage of a single property. You can do that. You generally will have the handicap that we talked about, the cons that we talked about, but you have the pros. And if managed well and if you're diligent enough, you would hopefully be able to outperform. Generally, here, if you have one fund, and that's the only thing that sits in your portfolio, you will be moving in a more consistent manner, generally, maybe, unless you're overperforming here, you have alpha here, but your beta is better. So you're not having drawdowns as much as you are having in a regular day, unless it's badly and oddly managed. At the same time, funds usually that run in a certain jurisdiction and a certain region, they purchase property in that region. So you're stuck with properties in that region, while with individual properties, you're able to select your region. You're able to exit a region fully and enter a region fully, able to exit much faster and enter much faster. Now, should you buy both? Probably. Does it make sense more for you to purchase a tokenized asset, a single asset, or a tokenized fund as a collective fund, or probably a few tokenized funds, maybe not one, maybe 5, maybe 10, and you use those funds as part of the portfolio? Yeah, most probably that's what you should do. You should have probably a bit of tokenized real estate and a bit of tokenized funds. If we remove tokens from the middle and we look at single assets or funds generally, you will see that funds are more passive. Most of that will be passed on, although tokenized real estate is passive enough, but it's even more passive to not even need to do the decision of the full due diligence, because probably you can't as deep as you can do it on a single asset level, where you can check if it's retail assets, every single tenant there. And if it's one tenant, everything about that tenant. So it depends on how passive do you want to be. How passive or how lazy. Now, some passive is because you can't, some passive is because you don't want to. And that passiveness has a value and has a cost, and you pay that cost. At the end of the day, tokenized funds, REITs, and tokenized individual assets have a place in your portfolio, because when you have the ability to enter and exit multiple assets, multiple jurisdictions, multiple methods, multiple times, it adds value to what you can access as an investor. For every single party listening to us today, regardless if your net worth is $10,000, $100,000, $10 million, or $100 million, the more money you have, the more difficult is it to deploy it right. The more important access is. With $10,000, it's less important to have a huge access, because you have access enough to deploy your 10,000 easily. 100,000, it's still at that level. When you have 10 million, 20 million, 50 million, access becomes super important. Now, if you have 10,000 and you have all of that access, you can benefit from something that's huge. And that's why people who have high net worth, ultra high net worth, they go for private banks that allow them, and private structures that allow them this access, allows them that flexibility. That is of value. Imagine that every single one of us has that access tomorrow morning through tokenization. I hope I didn't bore you today. Again, I'm Makram Hani from Blocksquare, and today what I want you to do is go to Ocean Point or any of the other platforms that operate on Blocksquare's technology and check it out. Check out the tokens that are available. You may like some, you may not. Good job, because that means that you have researched each and you have verified and identified what works, what doesn't, because not all of it will work. Doesn't matter who runs and how it runs. Doesn't matter or it does matter much what you choose and how you choose it. So check it out. Check out tokenized property, as well as why not check out tokenized funds. Most probably, you'll have something in both that's suitable for you, that will add value to your portfolio, and that will allow you to sit in a better position tomorrow. I'm buying tokenized real estate. I'm buying conventional as well. I hope you are, and I hope you benefit from that. Until next time.